Hi, I'm CNBC producer Katie Kramer. Today on a bonus holiday edition of Squawk Pod. Navigating this inflation nation with President of the Federal Reserve Bank of Cleveland, Loretta Mester.
We've seen really good progress over the last couple of years on inflation. We're not there yet.
She says the battle isn't over till we hit that target inflation rate.
It would be inappropriate to keep rates at current levels until inflation gets to 2%.
Maintaining an independent Fed and reflecting on her long career just a few weeks shy of her Fed retirement.
I've learned something at every meeting I've attended, and I've attended under 4 different chairs, so I've seen a lot.
It's Wednesday, June 19th, Juneteenth. Squawk Pod begins right now. Loretta Mester departs her role running the Cleveland Fed, one of the 12 regional reserve banks, at the end of this month. She's been a policymaker at the Federal Reserve for 10 years and was a deputy and a staffer for several decades before that. She has had a seat at the table for the central bank's fight against a 40-year high in inflation, there for the hike, and more hikes, and for the Fed's ongoing debate to determine when enough was enough. Regular listeners of this podcast know that we talk a lot about the Fed's delicate dance towards stability. In the wake of the pandemic, prices on everything surged: consumer goods, gasoline, technology inputs needed by manufacturers. Since the 1970s, the U.S. central bank has had what's commonly called a dual mandate. This was a congressionally determined clarification that the Fed's goals should be, quote, maximum employment, stable prices, and moderate long-term interest rates. Now, let's take the stable prices part of that list, inflation. What's a level of price fluctuation or increase that they can be comfortable with? For current chair Jay Powell and his predecessors back to about 2012, that level has been 2%. That inflation target was adjusted slightly to an average in 2020, but 2%, that is the magic number policymakers want to see price increases settle at before making any quick moves on interest rates. Thanks to the Labor Department's Bureau of Labor Statistics, we have measures of inflation to keep us on track. And last week's Consumer Price Index showed we are getting closer all the time to that 2% number. Prices in May of this year increased just 3.3% over a year prior. So, how's that dual mandate? Jay Powell, at last week's Federal Reserve rate announcement, they left things unchanged. It was just a few hours after the CPI reading, and he was optimistic.
Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high.
What will the Fed do next? And will someone about to move on to a new chapter even tell us? Loretta Mester sat down on the Squawk Box set with Becky and Andrew Ross Sorkin and our senior economics correspondent Steve Liesman to talk about this critical inflation progress. Steve kicks things off.
President Mester, thank you so much for joining us.
Thanks for having me.
It's been probably 10 years we've been talking since you've been president, and you are about to end your tenure as president at the Cleveland Fed. But let's start now with the short term, and then we get to the long term stuff. We've had a couple inflation reports this week. How did you process them?
No, it was welcome news. It was great news on the last FOMC meeting I was attending, wasn't it? Look, we've been working hard to get inflation down. We've been restrictive on our monetary policy. We've seen really good progress over the last couple of years on inflation. We're not there yet, but you have to look at the whole group of data and be happy that we're starting to see inflation move back down again after stalling a bit in the first part of the year.
Did the last couple months of better inflation reads make you feel like the first 3 months of worse inflation reads were maybe just an aberration, a turn of the year kind of price change?
So the January number, we knew there were some issues with measurement in terms of residual seasonality. But not really. I mean, you take the data as it comes. We had a stronger economy, and there was some balancing between supply and demand. You're going to get readings, and you have to take the data as it comes in, which is why we say we're data dependent, meaning that we take the data we think about what it means in terms of the trajectory of inflation and also labor markets, and then we set our policy to calibrate to that. So I didn't really change my view about inflation, but it is welcome to see that inflation is moving back down again. We'll just need to see that continue a bit longer.
So I want to ask an English question and a math question, okay?
Ooh, okay.
So the first question is, you said the Fed is restrictive. Are you sufficiently restrictive?
It's a good question. I mean, that's obviously an issue that we're talking about and the markets are talking about, and this is about, you know, how restrictive are you? Certainly, if you look at the effect of our policy so far, you can see it affecting the economy, right? We've seen it affect housing markets. We've seen it affect growth rates. We've seen it affect and bring supply and demand in the labor market back together. So it's definitely having an effect. Whether it's sufficiently restrictive, that's why we need to be data dependent and sort of assess where inflation is going. We've always said that we really need to have that confidence that inflation is moving down on a path to 2%. We're not going to, it would be inappropriate to keep rates at current levels until inflation gets to 2%. We're trying to always assess and looking forward.
That's the math question. I've had a nice correspondence with your former colleague, Jeff Lacker, both online and on air. We had him on. He thinks the Fed may not be restrictive enough, which I think Jeff has always thought, whatever.
The broader question about the Fed policy stance, I think there's a case could be made that they're not as restrictive as they thought. I think that's the broad theme of why they've been pulling back on expected rate cuts this year. I don't expect any rate cuts this year, frankly.
What are you looking at in terms of your baseline for where the neutral rate is to judge mathematically how restrictive the Fed is?
So, you know, in this summary of economic projections, which each, you know, participant on FOMC puts in, there's a long-run nominal Fed funds rate included in there. 2 SEPs ago, I raised mine to 3%. Okay, in recognition that there are a lot of trends in the economy that may mean that the higher rates are probably the neutral rate going forward. But at any point in time, right, it could be anywhere because estimates are going to be all over the map. Was sort of the neutral rate higher after coming out of the pandemic? I think so, for sure. Mm-hmm. We had disruptions in a lot of markets in terms of sort of the balance between supply and demand. We had labor market participation way down. As the economy evolves, right, you really need to assess, like, how restrictive are you? Are you seeing inflation move back to 2%? Are you seeing labor markets get into better balance? And we are seeing that, right? So now it's just a question of, you know, do we continue on the path that we're on, right, gathering more data, seeing inflation move down? And then once we get to a point where we're pretty confident that inflation is on that sustainable path, that would be a time to think about, you know, lowering the degree of restrictiveness. So I think we can't say at any point in time how restrictive we are, but you can see it as the evolution of the economy happens.
We spend a lot of time thinking, okay, are they going to cut in September? Is this going to be a November cut? It sounds like you think a lot less about timing and more just about what the data starts to slowly bleed in. How many months, if 3 months to the upside wasn't necessarily enough to say, okay, we can't figure out a trend there, how many months does it take of inflation heading down?
Yeah. I mean, again, this is how comfortable are you in assessing where inflation is going, but also the risks around that outlook. Okay. So to me, I would want to see a few more months of good inflation data, inflation coming down, you know, the short run inflation expectations starting to move down. And then, you know, then you need to start thinking about, okay, this may be the right panoply of data and, you know, portfolio of data, what's going on in the labor market, what's going on in inflation to actually move rates down. Because if you wait too long, right, if inflation is moving down, you're actually, by maintaining the current level, you're actually becoming more restrictive.
But hasn't that happened?
You have to kind of go.
Hasn't that happened? You've gone from just under 1% to now you're north of what, 2% when it comes to how real.
Yeah, but we needed to get. But remember, right? It's not that the economy is happening over here and our policy is happening over here. The policy is having an effect to bring that down. So you have to have these calibrated, right? You want to calibrate your policy to get inflation on that sustainable downward path.
While you're watching unemployment and the jobless claims actually picking up a little bit, I guess that has to go into the.
Yeah. So if you go back and think about when we started raising the funds rate. it was very clear inflation, part of the mandate, had to be key. The focus had to be on that. We had strong labor markets, inflation was going up and going up at a fast clip. We had to focus only on that, right? As inflation has come down, we've gotten more balance between our dual mandate goals. And you're exactly right. The challenge going forward is to assess the risk to both parts of our mandate, watch what's happening in the labor market, right, and take that into account, watch what's happening on the inflation side of the mandate, and make sure that we're doing the proper balance. And one thing that I've learned over the last 10 years as president and before that is you always make sure you're in a good position to be able to address risk to both parts of the mandate, right? And we're in a good position with policy right now. If things evolve differently than we anticipate, either on the employment side of things or on the inflation side of things, we're in a very good position with monetary policy right now.
One of the things we spoke to Janet Yellen about was the housing market, and given high mortgage rates, the lock-in effect that's happening.
Inflation has come down dramatically, but a substantial part has to do with the housing market and really reflects the fact that it takes time when market rents go up for people who have rental contracts to see, over time their rents go up too, but that takes a while.
But as that also relates to the labor market, which is to say, if you're locked in your home, you may not actually go take a job somewhere else in the country or possibly somewhere else even in your own state. How much do you think about that? And as it relates to housing, how much do you think about, it's not something I think a here and now issue, but 3 or 4 years from now, depending on where you think interest rates are, do you think that there's going to be a problem for folks who have to roll out of their mortgage?
So all the things you're pointing out are certainly things that are part of discussions right now in terms of how much is that affecting things. We have an inflation research center at the Cleveland Fed, and their work basically looks at sort of how long does it take the moving down of rents in new leases to feed through to housing inflation. And that's going to take longer than perhaps old models would suggest because of some of the issues that you're pointing out. Right now, the labor market's still very strong, right? So in some sense, that's probably lower on the list of things that we're concerned about, or I'm concerned about. But it is something that, as you think about how things are going to evolve, that's certainly one of them. And that's what's made this cycle so interesting in the sense that, right, a lot of these underlying structural aspects of the economy influenced where the economy was going. So if you think about the pandemic, a lot of those effects of the pandemic are still with us. They're having long-lasting effects in terms of labor force participation. Just think about what happened there. We're certainly not back up to where it was if you look at the total labor force. Right? That's long-lasting, and that'll influence how you think about the balance between full maximum employment and inflation. And that's what makes this a challenging time, but also as an economist, an interesting time to think about. But
some people are afraid you're going to miss the turn here, that you've missed it always in the past, and now you're going to miss it again. And that they look, for example, at the inflation rate, which I get is part of a base effect kind of thing. But you guys, you missed the inflation progress last year. And now you're even forecasting as a group, the average official, an inflation rate that is higher than what we're probably going to get at the end of May. So are you missing it?
I'm pretty confident that the committee is doing good work here. We're a learning organization, right? We learned through time. We took on board sort of where inflation went, and it went higher than we anticipated early on, right? And then we took action. And again, that's why I think it's really important that we maintain, a good place for policy, because the economy could evolve differently than that modal or that median outlook that's in the SEP. So, we put in SEPs every other meeting. We're going to be doing that. The committee will be doing that going forward. I don't think that, the discussion around the table feels like, we're totally out of whack with what's going on with the market. If you look at sort of where the market is and where our assessments are, they've come together over time. So again, we continue to assess incoming information that feeds into our view of where the economy is going, and where the economy is going and the risk around our forecast influences our policy decisions.
But we kind of have to wrap, but I do want to give you a chance to reflect on 39 years at the Federal Reserve, and 10 years as central bank. What's the best call that you made economically, would you say?
Well, I don't know whether I could say a best call, but one thing that I've learned over those years is that the Fed is a very strong institution. As I said, it's a learning institution. You come to the table with your best analysis and your views, but 2-1, I've learned something at every meeting I've attended, and I've attended under 4 different chairs, so I've seen a lot. And the chairs, of course, all have different styles, but they all come at it with the same view that we're working for the American public. Right? We have a very important job to do, and that's what's in that room. And I've gotten asked this a lot of times. It's like, well, politics has to come into it. I can tell you, in 39 years, politics does not come into that room.
Does it concern you, though, that attacks against the Federal Reserve have increased? Over that period of time, I think there's always been questions about the Federal Reserve from the political viewpoint, through the political lens. No president likes to see higher rates when he's running for a re-election in particular. Do you feel like things have gotten more politicized over that time period?
Not really. I think this ebbs and flows. And the best thing we can do as an institution is to really focus on the dual mandate and doing the best analysis, bringing the best judgment to those discussions, and really putting everything else to the side.
But what do you think? I mean, front page article of the Wall Street Journal 2 months ago effectively said that former President Trump, if he becomes the president, wants to, I don't know if it's true, but wants to effectively end, to some degree, the independence of the Federal Reserve.
Yeah. Well, having an independent Federal Reserve in terms of our monetary policy decisions is very important. It allows us to actually set policy really focused on having the strongest economy we can have for the American public. So, the structure of the Fed has been preserved over many years, and my hope and my feeling is that people will realize that this is a very good institution and it will be preserved.
Thank you for your
I'm going to make
service.
a guess here.
Yeah.
This is not the last time Loretta Mester is going to sit in that chair.
Yeah.
Maybe not as president, but we look forward to having you back, President.
Thank you.
Well, thank you.
Great.
And
Great.
congratulations
Appreciate
on
it.
your tenure.
Thank you very
And
much.
thank you for all your years of civil service.
Thank you very much.
Retiring not because she wants to necessarily, but because that's the rule, right?
Yeah,
at
I'm
the Fed?
ancient. I'm too old to serve.
There's a 65. And
Is
you
there
gotta go
really?
I'm too young to be president, but I'm too old to serve.
You guys got
There really is a 65 year.
Yeah. You have to adjust that rule. You have to, you have to seasonally adjust that rule for life expectancy, is what I would say.
I agree.
Thank you for listening to Squawk Pod today, the daily podcast that brings you the best of CNBC's morning show Squawk Box, plus a little extra. Squawk Box is hosted by Joe Kernan, Becky Quick, and Andrew Ross Sorkin. This podcast is produced by me, Katie Kramer, and Cameron Costa. We do have day jobs producing TV segments every day, so please let us know what you think of Squawk Pod, when or how you listen. We're on X. The handle is @Squawk, CNBC. Or if you follow on Apple Podcasts and get every day's pod right in your feed, you can give us a rating or write a brief review right on that platform. Enjoy your Wednesday, and we'll meet you right back here tomorrow.